Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is March 6, 2024. I'm going to begin with a piece I covered yesterday, and I want to talk about it, is the issue with technology layoffs, or layoffs in general, but most of them are in the technology field. There have been about, according to layoffs.fyi, there have been about 50,000 layoffs to date, and many of them in the tech sector. The website goes into detail about which company, how many layoffs, on what date. If there are multiple layoffs, they cite each one of those. This is coming after people have obtained the education, got the training, got a good job. Many of these are six-figure jobs, and thought, wow, I did well. I went to school. I've got some student loans. They're paying on their student loans and making a good living. And then what happens is they lose their job. And they probably are losing the opportunity to get that similar job somewhere else, because other similar companies with these kind of jobs are also laying off people. So the market, now this is nationally. Now I know you've got tech sectors in San Francisco and Austin and Seattle and so forth that are tech heavy, but tech is everywhere. So it's in other markets as well. And as people, it's 50,000 spread around, so you may think that's not too much, but it's going in the wrong direction. And as AI takes hold, which I think it is, then probably engineers are losing their jobs, and companies are they're replacing those jobs with AI engineers who can program to achieve growth and profitability with the use of AI. Okay, let's jump into the dashboards. The first one is this is the markets. So we have 4 U.S. markets, 2 international markets, and U.S. Treasury bond ETF, TLT. So there is the Dow, the S&P 500, the NASDAQ 100, and the Russell 2000. I focus on the pink box, the second box, which shows year to date. Now, these are pretty good numbers. I mean, these are amazing numbers, actually. So think of this. This is not a year. This is 2 months. 2 months. And you can see the rate of return of these indexes for this period of time. Economists who have been predicting the market for this year have predicted a modest rate of growth this year, maybe a 10% rate from January 1. And if that is the case, we are rushing very quickly to that number. That tells me that we are probably going to go beyond a 10% estimation of the market, and we are going to pull back some. It'll be, in my opinion, some of both. But you can see that the NASDAQ 100 is up about 8%, S&P 500 7%, the Dow 3%, and on down. At the very bottom, negative 4% is the long-term Treasury bond ETF, TLT. And it has been negative and continues to be negative for the year. And that puts a drag on stock bond portfolios. Not everyone's invested in TLT or in long-term bonds, but some are. And some are invested in intermediate-term bonds. But this is an indicator that that these bonds are basically down. The S&P 500 has 11 sectors in it. When you break those sectors out individually, this is what it looks like. So, sorry, I didn't put a pink box on there. So the second column in the middle, year to date, shows the rate of return year to date, beginning with the technology sector, 9.5%, and goes on down. And the last 4 in green are around 3%. The last 2 are actually negative for the year. So we have those that are in the 6, 7, 9 range, and we have those that are in the 3% or negative range. So as it always is, it's kind of a wide spectrum. And then to the right of that, we have the green dot or red dot, and this shows are they above or below their 20, 50, 100, and 200-day moving averages, going from left to right. All of them, except for 2 dots, are positive. Pretty amazing. So this will be about as green as you're going to get. We may get one where all of them are green, but I would say this is very, very positive, and probably is going to have some kind of correction before it goes on back up. That'd be my guess on it. Okay, so here we are. Put it into chart form. This is the S&P 500 represented by the ETF SPY, and this is an 18-month chart, a weekly chart showing one move equals 1 week. And I drew a black arrow showing from the bottom to the top, and you can see from the beginning of November, late October, you can see the trajectory on the right side of the chart where it just goes up, and it almost doesn't even take a breath. It just goes up, and that's the S&P 500. It is getting to a point where it is definitely overbought. I don't want to predict it's going to go down. Of course it will, but I don't know for now. For now, it is definitely in an upward trending mode. When I now I'm going to do a relative value, relative strength chart showing growth stocks, or the growth part of the S&P 500 called SPY-G, divided by SPY-V, the value component of the S&P 500. And so when it goes up, this shows that the growth stocks in the S&P 500 are in favor. When it goes down, it shows that value stocks are in favor. So they may both be going up. One's just may be going up more than the other, or they may be going down, and one's going down faster than the other, etc. So it's very much a relative strength chart. You can see that the direction by the black arrow, the direction is up, which shows that over time, over that period of time, that's about 14 months, that growth has clearly been in favor. When I take large companies, the S&P 500 is the largest 500 companies in the stock market. Look at those stocks compared to the small companies, and that's represented by the Russell 2000 Small Cap Index, and the ETF for that is IWM. So when, again, I do a relative strength chart, I show SPY, numerator, divided by IWM, denominator. When it goes up, this favors large companies. When it goes down, it favors small companies. There's some of both. But it does go over this period of time. This is from March, so it's about a year. So this favors large companies. Large companies, the stock has grown faster than small companies. But there have been periods of time where one or the other has been in favor. The long-term government bond, TLT, we looked at the data on that recently, and you can see this is a 54-month chart. That's a 4.5-year chart, and I did that so you can get more of a macro view. It goes up and down, but the long-term trajectory over that period of time is down. And so I've been talking about this before. This is why I don't do buy and hold 60-40 portfolios. Because the 40 component, that component of those portfolios in the last few years, it's not working. It's out of favor, and the long-term patterns, when you look at the long-term patterns regarding bonds, shows that at least for the last 2 major cycles, which would take us back about 80 years. It shows that there are long-term macro cycles that go way up and way down. And it looks like we have entered another cycle, which means that interest rates are going up over this next several decades, and that therefore bond prices are going down. I've shown that chart before, but it's an indicator that there is clearly weakness in bonds, and there is clearly weakness, lack of performance in 60-40 portfolios. The dollar, the US dollar, continues its strength, so it is an intermediate term trajectory of a positive, and going from a low in late 2021 up until present. So this shows strength relative to other currencies. So when we're spending our dollars in other countries or doing business in other currencies, then we get more for our dollar. When they're investing or buying things in the U.S., their currency does not go as far. So they have to pay up in order to invest in the U.S. or to buy U.S. Goods and services. Gold. Gold had a good week. Gold had 2 good weeks. So you can see that from the tick up on the far right of the chart. And I show you the longer or intermediate term trajectory over 18 months. You can see from the black arrow that gold has clearly been on an upward trajectory. Silver normally tracks with gold. However, and it has to some extent, but silver has been weaker than gold and continues to be weaker. It did have a positive week, but not as much as gold. When I put silver and gold on a relative strength chart, silver numerator, gold denominator, so when it goes up, that favors silver. When it goes down, that favors gold. It has clearly, for the last year plus, has been in a downward trajectory. This ratio has been in a downward trajectory, which favors that gold has been a better value for this period of time. Now, I've said before, I'll say it again, I favor silver. And I don't favor it as an investment. I don't look at it as an investment. It is an insurance policy against the decline of the U.S. dollar. So if the dollar becomes worthless or worth so much less than you need something else to buy goods and services with, that's why I have silver. But in this period of time, it has been out of favor relative to gold. Bitcoin. Bitcoin has been moving up rapidly and continues to do that. You can see from the move up toward the end of the chart that it has definitely been favorable. Volatility. Now, when the volatility index, the VIX, V-I-X, when it goes down, downward volatility means upward movement in stock prices, usually. So here we have a move down in the volatility index coming all the way down to 13. It went down as low as 12 and something, and I put my mark at 24, arbitrary number, that when it moves up through that number, that is usually a sign of higher volatility and downward stock prices to come. But it's a long ways from that. So we're in a positive market right now, and it is a trending up market. As you've seen from the previous charts, I think most people in the investment industry say this thing. They go, well, it's going to go up until it doesn't. And that's true. It's going to keep going up. And our investments have been, since November, has been invested in the market. And we've enjoyed this ride. I'm glad to have it. I hope it lasts a long time. I know that it won't last forever. But it is a trending up market. Asbury Research, they do what's called the Asbury 6. These are 6 indicators, different perspectives on the market and on equities. And so you can see that those are all 6 of those are positive. A cross-asset relative performance chart, also from Asbury, looks at things this way: one asset class or type of stock compared to another. Stocks compared to bonds. Stocks clearly in favor. High beta, or higher volatility stocks, are favored over low volatility stocks. The broad market, the S&P 500, is more favored than the blue chips, the Dow. Technology is more in favor than the broad market, the S&P 500. Growth is more in favor than value. Again, all of these based on previous charts that I've shown you. The U.S. is stronger in the last week. These are the three columns: the last week, the last month, the last quarter, than the developed markets in the world and the emerging markets. And government bonds are more favored than corporate bonds. And that's it. When we do a U.S. versus other countries or regions, the U.S., as you can see from this, the three columns, the last week, the last month, the last quarter, I won't go through all of them, but you can see that many of the countries, both in South America and Asia and Europe, the U.S. is stronger than most of them. The one exception is Japan. Now, Japan is really interesting. The market, now this is the market, this is not the economy. So the last quarter, Japan had a negative growth in their economy, but their stock market is surging and is moving up, the Nikkei, and has now crossed over, if you follow this, crossed over 40,000. Now, when you say Japan and stock market, most people think, I certainly think of 1989, when the Nikkei hit its all-time high and began about a 25-year, I don't know what the bottom was, a long-term decline. But it has been moving up and is now up and beyond 40,000. So that's the exception. So Japan is actually stronger during these three time periods than the U.S. Other than that, the U.S. is stronger than these other markets, or neutral. I took an example of one of those. I've shown this the last few weeks, Switzerland. The ETF is EWL and versus SPY. So relative strength. So when it goes up, this favors the U.S. SPY. When it goes down, it favors Switzerland. But it's a good example of a European country that shows the level of strength of the U.S. Now, this is not the dollar versus their currency, and it is not the economy. This is the stock market. Our market versus their market. Gold and silver. So you saw that gold had a good week, actually a good couple of weeks, and is up 2.3% for this week to 2,083, and silver is 23.18, up 0.7% compared to a week ago. The gold-silver ratio is 89-1. For a box, a monster box of 500 generic rounds of silver is $12,210. This is takes the cost per round, including the markup, to $24.42. If you change that to a tube of 20, it goes up 50 cents per round to $24.92. This includes the current spot price of $1.24. The market for gold and silver is soft right now. It is more, and which is why the markup has come down. This will change, but they go through these cycles. But right now, the cycle is a softer market than it was, let's say, a year ago or 2 years ago. Okay, thank you for watching. If you have questions or comments, leave them in the comment section below.